welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, April 4th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Let's see, currently we have futures that are pointing up. Dow futures up about 29 points, S&P 500 futures up 11, NASDAQ futures up 55. On a percentage basis, that's leaning a little bit more toward the NASDAQ, which is up about 0.4%, S&P a little bit more than 0.25%, and the Dow up about 0.1%. So after a couple of days of a little strength toward the Dow and the S&P and some of the more value-oriented stocks, it looks like this morning's futures pointing a little bit more toward the growth-oriented NASDAQ. Crude oil up another 68 cents a barrel. We're over $81 this morning. That's up about 0.85%. And the U.S. 10-year Treasury yield, which was down yesterday, is moving back up today, up about 3 basis points as bond traders sell off the 10-year just a little bit here this morning. Let's go into today's agenda that I have for you. So we are going to start off with the daily market recap. Talking technically, I've got a chart of the day for you. Manipulation update. I've talked a lot about manipulation over the last, 8-10 months. And it is continuing, and I'll show you what I mean by that. Then earnings spotlight. We'll wrap up with the 3 you must see. Let's go ahead and jump into that market recap and take a look at what happened on the first day of the second quarter. The Dow Jones Industrial Average was up 327 points. That was almost 1%. S&P 500 up 15, roughly 1/3%. The NASDAQ down 32, which was down almost 0.3%. Mid caps and small caps both straddling the flat line, relatively even for the day. Mid caps down a point, small caps up 2/3 point. So again, not much movement there. Looking at those AD lines, though, we did finish on the highs on Monday, and that is a good thing for AD lines. If you're not familiar with the AD line, it's the accumulation distribution line, and essentially the formula ignores gaps. So what you're looking at is simply whatever happened from the opening bell to the closing bell. If you finished right in the middle, if your close was right in the middle of the day's action, then there'll be no change in your AD. If you finished in the upper end, then there'll be move to the upside in the AD line. If you finish in the lower end of the trading range for the day, then your AD line will drop. Volume is used essentially as the multiplier. So you've got, if you finish all the way at the top, in other words, you finish at the close of the day or high of the day, like you did yesterday, we saw the Dow, S&P, NASDAQ all finishing near the highs of the day. When that happens, then you'll see the AD line go up by 100% of the volume. And that's all it does. It just adds and subtracts volume based on where you finish each day and where you finish within the trading day. You finish at the top, the bottom, somewhere in the middle. So all of that just kind of factors in to where this AD line goes. But the good news is it's pointing higher. So as we look at the market and we look at what I think is the bullishness of the market, the AD lines simply are confirming that bullishness. Energy stocks, big lift, broke the downtrend line. This is a volatile group, and yesterday was a volatile day. Over the weekend, OPEC came out and said they were going to cut production by over 1 million barrels a day, and energy futures immediately soared. We saw most energy stocks performing very well on Monday, and the XLE you can see finishing higher by about 4.5%. Most of that was at the gap. We didn't see a whole lot of follow through. Didn't see a whole lot of selling though either. So it was mostly just a gap up and then sideways consolidation for the most part. Healthcare had a nice day, up little over 1%. Real estate leading the losers, down almost 1%. Discretionary down 0.9%. Utilities down just a little bit more than 2/3%. So it was a bifurcated day. The energy group absolutely helped the market, especially the Dow. more so because it is a little bit more influenced by energy names like ExxonMobil. But overall, it was kind of a bifurcated day, and that's okay. The market has had a nice run. If you look at the second half of March, I think the pre-earnings run started maybe a little early. So we had the Dow finishing March pretty nicely, about where it was earlier in March. The S&P actually took out that earlier March high, finishing above 4,100, tacked on a little bit yesterday to start the second quarter. NASDAQ had come back very significantly, had moved back up to 12,000 back in with maybe a week and a half to go in March, pulled back one more time, and then it too has come roaring back, even though it was a little bit of an underperformer on Monday. But overall, I think the market action looks pretty good here as we start the second quarter. And historically, I can tell you the first half of a quarter tends to be much stronger than the second half. Notice I say tends to be. That is a trend over the last 73 years, dating back to 1950 on the S&P 500. So we tend to see the market do very well. And that kind of fits in with that old Wall Street adage, buy on rumor, sell on news, because anyone buying right now heading into earnings season is buying on rumor. Then the news starts to come out in mid-April. We get through earnings season. Most of the big companies, first tier, second tier kind of companies, have reported by the middle part of May. I mean, there are definitely some stragglers. We have some big reports to come out after mid-May. Don't misunderstand me. But the overwhelming majority of companies, key companies, have reported by the middle part of May. And that's where I think you get into the sell on the news kind of a market environment. But anyway, that was our recap for Monday. Did not get off to a very good start. One thing that was interesting to start the day was that growth was out of favor. And that kind of makes sense because if you've got energy moving higher, then you would expect that the folks looking at inflation are going to start hyping that up again. And you're probably going to see more value-oriented stocks do better than growth-oriented stocks. Inflation's not good for growth stocks because you're talking about eating into the future earnings of companies, growth potential, earnings growth potential. And that's not a good thing for growth stocks. So anytime you start hearing inflation or you're worried about inflation, you got to be careful with those growth stocks. Well, the interesting part on Monday is that late in the day, we started seeing growth outperforming again. And perhaps even more important was the 10-year Treasury yield, which opened up yesterday a couple of basis points, which you would expect. Anytime inflation is expected or anticipated, bond market investors are going to require more yield to offset inflation expectations. If inflation's supposed to jump another point or 2 points or 3 points, you're not going to accept the same yield or less yield. So I follow what's going on in the bond market, the long end of the yield curve. I tend to follow that area of the market whenever I really want to get a sense of inflation, because we should see the yields soaring as a result of inflationary expectations rising. And what we saw yesterday was the opposite. After an initial gap up, we saw the yield moving down. Folks were buying the 10-year Treasury bond. Think about it. Why would you do that? Look at this. That was the opening gap. That was the inflation reaction. And then look at what was taking place most of the morning before we saw a little bit of recovery in the afternoon. It was a huge drop in yields. Bond traders were pouring into bonds. Does that sound like they're worried about inflation? I don't think so. And I'm not worried about it either. So 10-year Treasury yield, I think, gives us one clue, something to at least think about. I don't listen to the news. Well, I listen to the news, but I don't listen to the media talk about the news, because all they're doing is using clickbait and trying to get more and more viewers in. And so they're going to try the scare tactics to drive viewership. And I don't use that. I use my charts. The charts tell me what's going on. The charts tell me what Wall Street is doing with their money. Do you want to know what Wall Street is doing with their money? Or do you want to know what the media is talking about and hyping to drive viewership? Pick one. It's really that simple. I'll follow the charts, thank you, and let the charts do the talking for me. And I think the bond market spoke yesterday. Let's move on to talking technically. And you can see another strong finish, by the way. Notice these hollow candles, the strong move that we've had coming up off of the low on March 13th. It's been a really nice rally. We did get back down almost to 3,800. That 3750 to 3,800, actually 3750 to 3775, 3780 was kind of the key support area for me. So getting back down and holding above 3,800, I think is perfect for my belief the market's going higher. Now, in order to really confirm that, we've got a couple big levels to take out on the S&P. The first one is going to be up at 4,200, the February high. And then the second one, the really big one, will be 4,300. And I say really big because on a weekly basis, this is the higher high, the lower high coming down. We kept putting in a series of lower lows, lower highs. That is the last lower high. And this is the last lower low. And everything that's happened since October is trading in the middle. We haven't broken down. We haven't broken out. That's the long-term chart that you need to follow. So we don't actually confirm a bottom until we get back through 4,300. But as I've said many times, the problem with sitting out or being short until you take out 4,300, you're going to get your, you know what, handed to you over the last 5 months. I mean, it's no fun if you're sitting in cash from 3,500 to 4,300. And I get asked a lot of times, why do you try to call tops and bottoms? Well, first of all, I'm really good at it. I've developed some strategies and some techniques, signals that I think are really solid indicators. Do they guarantee anything? No. But do they help me manage risk? Absolutely. When I called the market top at the beginning of 2022 and said we had trouble ahead, I didn't guarantee anyone that we were topping. What I said was that it was too risky to hold stocks on the long side anymore. And then as the market rolled over, it confirmed the bear market that I suggested we could be in for. When I called the bottom in June and then came up with kind of a bottom 2.0 in late September, it wasn't that I could guarantee anyone it was the bottom. Again, what I said was the risks of being short or in cash were too great. That's different than guaranteeing a bottom. At this point in time, I thought the odds of the market going higher were a lot greater than the odds of the market going much lower. And when that's the case, wouldn't you rather be long? There was an article that I wrote, I think maybe in August, September last year. I don't remember exactly when. And I provided a lot of this information to members as well. But what I was doing was studying the history of bear markets and the first 6-month performance after a bear market low and the first year performance after a bear market low. And if you miss those moves to the upside, you miss significant opportunities. And really, missing that can be life-changing over your compounded returns that you get over years and years of lifetime investing. It's much better. Is it better to buy when the S&P is at 3,500, or is it better to get back in when the S&P is at 4,300? Hopefully you don't have to think and ponder too much about that question. So let's talk a little bit about market manipulation, because I discussed this many, many months ago. I talked about this when I first called the bottom in June of 2022. And so I'm going to give you a little update on what has been taking place and how this is the QQQ. The QQQ, if you're not aware, is an ETF. It's a basket of stocks that tracks the underlying NASDAQ 100 index. That's what ETFs do. They track something. They track an index. They track a sector. They track something, and they use a basket of stocks to do so. And it helps. I mean, you can diversify because you can get into the NASDAQ 100, all of those stocks, with one single investment. You don't have to buy 100 stocks. ETFs are pretty cool. Anyway, the QQQ tracks one of the most important indexes for me, the NASDAQ 100. And it's one of the more important indexes for me because in a secular bull market, aggressive growth stocks tend to dominate. And that's essentially what makes up the NASDAQ 100, mostly aggressive growth. So let me explain what's going on here. At the top, going into 2022, there were a number of signals telling me that the market was likely to go lower. One of them, toward the top of the list, was sentiment, extreme bullishness and sentiment. That needed to reset, which it has, by the way. Another thing that I looked at was in the month of December, the consumer staples sector went up 10%. That's a defensive group. Consumer discretionary, the aggressive side of consumer stocks, consumer discretionary was flat for the month of December. 10 percentage point difference between consumer staples and consumer discretionary. And that was like the poster child of money rotating into defensive-oriented stocks to lead the final push higher in the S&P 500. Meanwhile, during that same period, December, and even into the latter part of November of 2021, we saw a lot of bearish manipulation taking place in the market on an intraday basis. So the market had been going up, up, and up. You know, I think traders at that point were pretty brainwashed. Everybody thought the market was going to keep going up. Remember those meme traders, Wall Street bets? Everybody thought the market was going to go up. The stock market was everyone's personal ATM machine. You just bought stocks and they went higher. 2021 was a massive up year. Coming off of the 2020 pandemic low in March, we had the largest 22-month up move since the 1930s. Think about that for a minute. Since the 1930s, that was the biggest move. Sentiment was so bullish. And during the trading day, this is net gaps for all of these days highlighted in this lavender, pink, whatever color. The gaps totaled, it was a net gap up of $6 during this period. Now, what you can see is that during this period, the QQQ was relatively flat. It started this period just below 400, went up above 400, then right back down. Here we got up above 400 and finished just below 400 on the QQQ. I'm looking over here. So it was relatively flat, but opening gaps, we saw going up $6. The first 30 minutes of trading, which I call amateur hour or amateur half hour, whatever you want to call it, the QQQ moved up on a net basis all of these days, another $4. So from here to here, if all you did was follow the opening gaps in the early morning trading, the QQQ went up more than $10. But from 10 to 11, that's where we saw most of the selling take place. But just call it, balance of the day. If you net these two, we ended up going down roughly that $10 or $11. And that's why we finished equal. So just start picturing in your head that the market was gapping up and institutions can't get out. They can't sell millions of shares at the opening bell. There's not enough liquidity. So whatever they end up selling has to take place during the day and over a period of time. Market makers Their primary responsibility or their primary business goal is to get the best possible price they can for their institutional clients. That's where they make their money. Well, when you're trying to get out of stocks, the best way to get out of stocks at higher prices is to see gap ups, which is what we saw, to see morning strength, which is what we saw. And then they are able to unload their shares at higher prices. Now, once we turn the corner of 2022 and we started moving lower, here was the massive distribution that took place. All this selling from January to May 20th. The gaps were down $30. Amateur hour was down $35. 10 a.m. to 11 a.m. was down $33. And the balance of the day was down over $14. Pure distribution all day long for 4 months. There was your bear market. That was the majority of your bear market. Since May of last year, and by the way, this is before all of the rate hikes. What do we have? 4 75 basis point hikes, couple 50-point basis hikes, couple 25-point basis or 25 basis point hikes. All of that took place after this May 20th close. All of the major rate hikes were in here. And everybody's saying, hey, don't fight the Fed. That's everywhere, right? Everybody talks about it. And while all of that was happening, guess what? This selling was carrying over into the gaps. Since May 20th of last year, gaps on a net basis down $51. First of all, I want you to look at where we were in May of last year on the QQQ, around 287. Where are we now? 320. What is that? It's up $33. Gaps were down $51. Amateur hours down $11. That's $62. We were down. If you got in to the QQQ at the close and got out at 10 a.m. the next day, you were getting killed for the last 9 months, 10 months, almost 11 months. But look what was happening balance of the day. 10 a.m. to 11 a.m., we were up $12. From 11 a.m. to 4 p.m., the net of those 5 hours every day from May 20th to the end of March, it gained $83. Folks, who do you think's buying? Retail traders are panicking. They're still bearish. The majority of people are still bearish. Look at this rally. I don't get it, and I keep preaching it, but everybody's got to do what they're most comfortable with. And you know what? If you're following the media, it's going to be hard to get out of the cycle. That's all I'm going to say. So let's move on. I want to talk about the, here was the chart of the day. I went backwards. I apologize to everybody. But here is the chart of the day. I just want to point out computer hardware relative to the S&P 500. First 3 months of this year, it's out of sight. And the reason, pretty simple. Apple making the huge move and continuing to move up, broke out above this key 155 level, now charging toward 175. I think we're going to hit it. I do want to mention that we are having a free webinar on Saturday, April 15th. This is the Bullseye Forecast. Outsmart market manipulation for more profitable trades in Q2 and beyond. Don't miss what I think is going to be the rally. And I'll talk all about it and what I see on Saturday, April 15th. Tomorrow, you can register. You can also, we'll be sending out an invite to our Earnings Beats Digest newsletter. It's a free newsletter. Name and email address gets you into that. But seats to this event are going to be limited. The only way I can guarantee you a seat is if you are a member of Earnings Beats. And a free no-cost trial to our service will get you there. So if you really want to make sure you guarantee a seat to April 15th, sign up for our trial. All right. Let's keep moving, running out of time here. Going into earnings spotlight. Not really a whole lot. Just wanted to mention Acuity brands reported better than expected results, down a couple percent this morning. MSM, this is MSC Industrial Direct. Also, I think this one actually was up a few percent. They beat on their bottom line. And then Lindsay Corp beat on their bottom line, but actually down about 6% last time I saw in pre-market. And that looks like that downtrend still in play. All right, last thing, 3 you must see. I just want to show you quickly 3 Dow stocks that were on the bottom yesterday in terms of performance. So the first one is CRM. I'm also going to go over Nike and American Express. But let's take a look at CRM first. CRM pulled back, but it's in a very, very strong uptrend. I think first key support is going to be down around 193, right about this opening gap from earnings. Went back down, then we broke out above it. So that now makes it support. If it does trade below it, watch that rising 20-day. Nike, I think, continues to look pretty good after a huge move up through January. I think it's sideways consolidating. That PPO is coming back up, just moving back up through the center line. Look for a break above 126, 127. That would be your cue there. And then AXP, I will say American Express likes the month of April seasonally, but technically needs to get back through this 20-day moving average and hold. If it does, I think this is one that can run back up to 180. That would be about a 10% move from where it is. So I like AXP. Anyhow, that's it for me. Appreciate everybody tuning in. Want to wish you the best today. Continue to tune in, and I'll see you then. Happy trading, everybody.